All right, welcome back. Welcome back to another episode of Forex Tech Magazine. It's your host, Lewis. Hope everybody's doing well. Before we get too far into this, I want to put out the disclaimer real quick. The disclaimer goes a little something like this. Any and all information is given to you by Forex Tech Magazine should be considered to be for educational and entertainment purposes only. Nothing that is received by us from you, received by you from us should be considered to be financial information. This should be considered to only be for educational and entertainment purposes only. If you're in need or if you're seeking financial advice, then our advice to you would be to seek the services of a licensed financial advisor. So, with that being said, let's go ahead and jump right on in to what you came here for, which is, I would presume, to be some information about trading. Hold on one moment. All right, so let's see here. So let's see here. Let me just do a couple things real quick. I want to check, make sure all my streams are up and running. It looks like this stream is not, so let's figure out what's going on. All right, so now we are. All right, good deal. All right, so what do we leave off at? Yesterday we were looking at a couple of different pairs. We looked at the Great Britain Pound, Japanese Yen, and we looked at the there's a Great Britain Pound and the Canadian dollar, and we were talking about places and trades. And so we did, and let's talk about it a little bit. So let's talk about what went right, what went wrong. So this is the Great Britain Pound, Japanese Yen, and I placed this trade. First, let's look at why we placed this trade. Let's clear the screen. Okay. All right. So as you can see, we're in a downward channel, right? Price is moving down. Now, one of the things that we notice about this particular pair here is that even though price is moving down, it looks like it had a point where price was pushing back up, and it looks like that it was breaking above that previous swing low, right? So it got us curious to think that price is still going to continue down, but there was some more move that needed to be made upward before price continued to go all the way down. And so what we did is it's kind of what we call a Gartley pattern. You know what I'm saying? A little pause in the downward trend. And if you notice right here, you see price had broken out of that downward trend, right? It's moving up for a little bit, right? And then it's coming back down. And essentially what happens, I'll put this on here, let's see. Clear it up, let's see here. Got too much stuff going on the screen, man. This is what happens when you get too much going on. Get too much going on, and you can't really tell what's going on. You know? All right. So anyway, so here we go. So we saw that this was our A to B, right? Or at the time, so we thought was that A to B. Probably A to B should probably be right about here. So I might be off a little bit on my calculations as far as um, where my A to B was for this particular pair. At any rate, I wound up coming in here. I wound up getting in here. My entry values wound up being here. I put my stop loss here as well, right? Because this is a nice little swing pattern for me. And also there was a bullish engulfing candlestick. So I thought that, hey, you know what? This is, ideal for a for area to purchase. He did. We enjoyed some success. The price went up. Unfortunately, later on this afternoon, later on in the day, price went down, hit our swing low, and hit our stop loss, and then stopped us out of the trade. Now, there was a couple things that we could have did better with this particular trade, and one would have been to put our stop loss here below our 80, all right? That just means that we would have stayed in the trade a lot longer. Also, too, the downside of that would mean to have more at risk, right? Here, we limited our risk. It's pretty conservative. Well, it's pretty aggressive stop loss, which is good. But we were limiting our risk in anticipation that price was going to push forward, a lot sooner or whatnot. But unfortunately, it didn't. The other thing we could have did was just pick the better entry for ourselves. And so, well, how do you pick a better entry for yourself? Well, glad you asked. Although coming in and looking at a counter trend line break helps us kind of determine, whether we should be buying or selling, and considering the fact that price has moved above this trend line that's going down, that lets us know that, price is on the buy side now. So that lets us know, okay, that we should be looking for, buy-in entry points potentially for this pair, right? What we didn't do, what I should have did, right, because this trade price should have been at A to B here. All right, we look for an additional counter trend line break, showing that okay, now price is actually moving up, because even though it's on the outside, it's still moving down, right? So what we have to do is we need it to get a break that's moving out. So essentially, and hold on a second, I'll clean this up here. Hopefully make all this plain to you here in a moment or so. Essentially what we were looking for is an entry, right? So this is our A and B. This is our AB here, right? And then price is moving down. What we're looking for is our C to push price up, right? For our C to D to be able to push price up, right? And the way we do that is when we get a counter trend line break, right? From the A to B, from the C to D, right? Once that C breaks that counter trend line, right, as its way going to the D, that should be our entry. So our entry should be somewhere here on the outside of this trend line, right? Because this is the new trend line. This right here was the first wave up, the impulse wave up, right? And this right here should be the wave going back down. So this right here should actually be extended. Let's see. Put it here. I'm going to extend that. And if we're honest with ourselves, when we look at where we are right now, it's quite possibly that it's going to be this blue to blue, which is still, this is where we were originally at anyway with that red, right? Because the red we had it marked off here. With that extension, that was our D. This right here, the black line was our D extension originally. But because we moved the length of what that move was, right? This is the A, this is the B. We're coming back down. We're going to say this is probably the C right here, right? As it's bouncing off this trend line here. The move though to C would be, will it break through this trend line on this side, right? This is the trend line right here to let us know that we need to be looking for our, we're breaking through. So this is, looking for our AB extension now, right? This right here is the trend line to break to let us know that, hey, our C is on our way to our D, right? So it's, and what I did is I got in a little earlier here just because I'm looking at the candlestick formation. Same candlestick formation over here. You got a bullish engulfing, right? So that means there's energy coming into the market, which makes sense because the London open, so energy is coming to the market now. But if we go back and we look, let's look at the Canadian dollar. right? So this is the one that we were in that actually did work the way we had anticipated to work. And let's follow the same principles. Look at the same principles and see if it works on here. Because if it works, it works, right? And if it doesn't work, it doesn't work. And it's point blank. It just is what it is, right? Same principle. Price was going in a downward trend, right? So wait for price to break through that downward trend, right? Which it did, right? And we went in and we showed that upward motion, right? That first wave, right? It's our A, it's our B for that first wave up, right? It's our A to B. And now what we're looking for is our C to D, right? And so how do we find our C to D? Well, we're going to wait for price to pull back. Price still went up a little bit more. Price began to pull back, right? And so price is pulling back in a downward trend. And what we did is we come over here, show that downward trend line, right? Not going to buy until price crosses over that downward trend line and gets onto the buy side, right? Now we're on the buy side of the C. All right, so now, so let's go back over this again. First was the signal that the trend is changing and that we can go in and we can use a fib, right? That's the first thing, right? Because price was in a downward trend, right? And so typically in price in a downward trend, what we're using, we're looking at fibs, but we're looking at it from a sell side, right? That's what we're looking at it from. We're looking at it from the sell side when it's in a downward trend. Come on, work with me. Let's see. Looking at it from a downward trend, looking from a downward thing. So you see right here, as long as we're in a downward trend line, as long as the price hasn't crossed over this trend line, we're looking for sell signals, right? So once again, if we look at this one right here, right, we pull back to the red, so that means we should be looking to the red for our target, right? Boom. We did. It completed this Fibonacci sequence here, and as it completed this Fibonacci sequence here on the downward side, we see that the downward trend line was broken, right? Which lets us know that now we should be looking for buy signals with our Fibonacci sequence, right? We gotta wait for the setup, but we should be looking for buy signals, right? So once we go in, we see that we could be looking for buy signals. Now what we do is we wait, right, for a swing high and a swing low. So this is a swing low, this is a swing high, right? We got two candlesticks over here to the right of it. That's lower than the candlestick that was over here to the left, to me left. I got two candlesticks that's higher than the candlestick that's over here to the. I'm sorry, this is to the right. This right here is to the. This right here is to the right of this one. So once again, we got swing high, got swing low, right? And we look at this candlestick wick right here, right? Look at this candlestick wick. Look at this candlestick wick, right? Swing high, swing low, right? So now that we know that we got that, now what we need to be doing is looking for our C. So we're looking for another swing low. That's going to be our C, and then we're going to look for, right? And this is very important. We're going to look for, this is the downward trend, all right? As price retraces because of this big move that it pushed up, right? And so as price retraces, we're looking for an entry point, right? And the entry point is going to be when price breaks this downward trend line, right? Because we know that our C is going to be down here at the swing, but we want to make sure that we get in because what can happen is, price goes in here at this swing, it can go up till they hit that trend line, and then it can bounce back down, right? As you see here, this is the start of the swing coming down. When we started the trend going down, price goes down, price goes down, price goes down, it comes back up and hits that swing, hits that trend line, and it comes back down, right? Same thing, price hits the trend line, it comes back down. We're waiting for when price is able to close above that trend line, because then that's signaling us that, hey, price is on the move. We should be looking to buy. We should be looking to get into this because price is pushing up, and then we should be looking at hitting our target, right? Which is since our swing is swung all the way back to the red, so we should be looking at the red as our target, right? It didn't go into the purple. And that's exactly what happens, right? Exactly how it played out, right? You broke that counter trend line. Boom, what happens? Price is now pushing back up towards our target. You guys see that? Hopefully you're able to catch that. Hopefully you're able to see that, right? As of right now, with this particular trade, we have over, well, we got 99 pips. It was just 100 pips. But 100 and right now $56, which is really good because off this first trade here, I lost like $409. So I am up altogether, what's that, 300 and some dollars, which is good for about, what, 20 minutes worth of work yesterday. And I haven't done anything other than just put stop losses in place and just let this currency pair play out. So that's pretty good. But I want you to understand how and why we got this buy signal, right? And what it means to our trading, The other thing I want you to look at too is the fact that we were able to use effective stop losses. So I'm gonna go back over here. And the stop loss helped once again control our loss. And like I said before, we could have did a couple things. We could have came down and did a more conservative, place it below the A stop loss, and then as price moved up, could have brought our stop loss up accordingly to our swing positions inside of our trade. Okay, the swing low here or here, as price moved up. But the better choice would have been, and usually when you opt for that method, it's probably more so because you're not really sure where your C is at, or really you haven't crossed over that trend line. That's what I think personally. I think you haven't crossed over that downward trend line, and you're not really sure and about where it should, where your C is at. And I think that causes a lot of folks to basically get into a trade prematurely. And when you get to a trade prematurely, you're going to have problems. It can definitely lead to problems. But here we go. It's like I said before. That's one way you could have did it. The better way to manage it would just be to try to get in, try to look for a better position. I'm trying to move this right here. Let me see if I can do this right here. Let me see something. I'm going to try to get rid of that. I'm going to try to drop a hand. What I'm trying to see here is if we draw it out by hand, we most certainly could. I mean, yeah, you draw it out by hand. Price went through, came back down, and now it looks like it may be proceeding to come back up. This area is a tough one, and just kind of keep in mind, there's nobody out there that wins 100% of the time, but I think your probability of success is going to be a lot higher if you trade in this fashion versus if you just kind of go out there and just kind of wing it, so to speak, right? I'm trying to look see if there's anything we could have did better in this trade. I don't think, like I said, I don't think we could have did better in this particular trade. It's just waited. That's about it. I mean, that's it. I mean, sometimes you're gonna get out there and you gotta get it right. Sometimes you're not. And I think the waiting part just comes in from trying to get in a better position. And like I said before, you also could have came in and lowered your stop loss below the A, but then that just exposed you to more risk. And I don't necessarily like that strategy just because the ideal is to try to, if you're wrong about a trade, to get out of the trade as soon as possible and allow yourself to get back into it at a later date. You know, I mean, like even now with this particular one here, don't know if I get in it at the moment, but at some point in time, there's going to present itself the opportunity to get back into this trade. And then the question is going to be, all right, so do I get back into it? And if I do, you know, what is going to be my risk to reward ratio with these, the ones that we put on last night? I think we had about a 3 or 4 to 1. I think it was like 4 to 1 reward risk ratio, which is awesome. These only had to win one, and I could have had 3 losses, and I still would have made money. Or if I had 4 losses, win one time, and I would have broke even. So it just makes it easier when you trade to kind of trade with those, the probability, those numbers like that in your favor. As you can see now, we're up 792, so we lost 409, we're up 792. We're close to being up to about $400 almost, which is awesome, considering the fact that we had 2 trades on yesterday. One trade didn't work out, one trade did, and we've already made the money back from the one that didn't work out, and we're profitable from the one that did. So, and thank God we're on our way to hitting our take profit and closing out this trade, and then using that money going someplace else, right? So this is ideally how you want to trade. And like I said before, these patterns are always throughout the chart, so you just gotta look for them. That's all it is, man. A B C D. That's it. If you say A B C D or 1 2 3 4 or W X Y Z or whatever you want to use to just use your little place marker. Just remember how it moves. I mean, it just means, because all we're doing is just measuring prices moving up in the first wave, right? Then it's gonna pull back because of a little bit of exhaustion because of that wave that it moved up. And so essentially what it says, the first wave or this wave here is people catching news or people or some type of news or some type of information is coming to the market. It's getting buyers coming into the market, right? And if it's a downward move, this means some type of information came into the market. It got sellers coming into the market, right? And then what happens is that these buyers come to the market, people begin to take profit, right? Because they're saying, hey, you know what? We made a lot of money. There's no need to keep risking it all. Let's go ahead and take profit, all right? Get some money off the table and pocket it, right? So as they do, price begins to pull back, okay? And as price begins to pull back, that's great. Now, what happens at a certain point, price pulling back, more buyers are becoming aware of what just happened in the market. Like, wow, it was some really good news that came out about this, or hey, this was pretty interesting. And I think it does have some more room to go up. So more buyers come into the market, right? And they begin to push this thing back up, right? They begin to come in and buy in and they push it up. Now, people always say, well, is Fibonacci, is that a real trading tool or trading instrument? And the debate is going to always wage about whether it is or whether it's not. I will say this right here, though, it's real to traders. And so if it's real to traders, then it should be real to you. And the reason why I say that is if everybody has a target of here, right? And that means that people are going to be piling into this thing as it moves up closer to that target, because everybody else's target is going to still be that same target. If we're all looking at the same thing, we're all believing it's going to the same place. As long as it hasn't reached that destination yet, that means there's going to be people coming in, putting money in hopes and anticipation that it's going to hit that target. All right. So whether it's real or not, people by their belief is going to kind of make it real, because they're going to be pushing it up towards that number, right? And then of course once it hits that number, there's a lot of sell orders that's going to probably be around this location, and that in turn is going to go out, cause the product to fall back after it hits that number. So Whether there's some cosmic force, whatever, that pushes everything there or not, I don't know. But I do know that if people are watching this number and it's something that people believe in, then there's going to be a lot of buy orders in to push it towards that number. And then once it gets to the number, it's probably going to be a lot of sell orders there to take people out of that trade. And once again, that's going to have a direct, real impact on your bank account, right? On your trading account. All right, so that's what went right. That's what went wrong with those two trades. So we got the one trade that went right, and once again, I think it really comes down to something simple. Is just far as we were able to pinpoint, the high and the swing high, swing low, right? It crossed over this downward trend line, so lets us know that we should be looking for potential buy signals, right? Then we saw the downward trend after, this thing swinged up high, right? So now we get the exhaustion, right? And as it gets exhausted, we see that it comes down to the red. And now we see that, price in itself is making its way up towards the its price target up here, which is at the 1.70603, which is our price target. And, let's see here. Yeah. And that's just saying that if my price, it's just saying that if I thought that this right here would be a better swing, and even so, we're still on red to red. Just means that the target moved up a little bit, but I'm happy with where the target is at right now because it's also in the confluence zone. That's right there where our support resistance lines are at, and I'm okay with it being right there. So just me double checking some things. But you guys get the gist of it. And you see, basically how to say too much. How to trade this pair. And like I said, man, almost $800. Only, within a 24-hour period, which is good. And that's only trading like one standard lot. Imagine if you traded something like a couple thousand right now instead of talking about a couple hundred. And so that's really the kind of the power of the Forex is the leverage ability. But before you start going in and using a whole lot of leverage, which you need to kind of be familiar with, is support. So when price broke through that trend line, that downward trend line, and it came off of that support, it gave added, assurance that hey, we're making the right decision here. Let's go ahead and buy with some confidence, and let's see what happens. And of course, we'll see what happens as price is moving up. So that's a good thing. So let's get out of here. Let's look at the Great Britain pound and zillion dollar. Tiger. Let's see here. Let's look at the daily so we can see what the overall movement is. So it looks like the overall movement is going down over time. Now the question would be, is that something that we want to trade? Let's see. If you guys happen not to know, the software that I'm using is the Smart Trader trading software. I love it. I highly recommend it. And we'll give you a disclaimer that we are an affiliate of it, so that way if you do decide to use it, just understand that we get paid if you purchase the paid version of it. But I would recommend it even if I was not an affiliate of it, just because of the fact that I do believe in it. I think it's a great software. They have an automatic Fibonacci drawing tool. I like to hand draw it myself, but if you're not really sure where to place your Fibonacci's, put your A and B boundaries at, it automatically come in here and do it for you, right? And as you can see, it automatically do the AB. This rate should be the C, so our D extension should be here. So this is where our point is that we'll be looking to take profit from here. Which is cool. So let's think here. Looks like that price is gonna be coming down. How many? What do we got here? So it's like 435 pips between where we're at now and where it should be. And then there's 187 pips from this swing point here. Almost 200. So now the question becomes, well, okay, well, it's 400. 440 just about pips. So it's basically almost like a 2-to-1 risk to reward ratio, right? 200 is here, 400 is here. So what you have to ask yourself is your trading account big enough for you to take a 200 pip loss and still be okay to trade tomorrow? And when you're in pursuit, it's 400 pips. And most people are probably not going to be okay with that. 200 pips is a lot of money. It can be. Right? So the question becomes, well, do I trade that or do I trade something different? Well, that's why we look at the lower time frames and try to get some ideas to see, well, maybe we should be trading off for something a little bit, a little less volatile, right? Let's see, thing, two, three, 15. Mm-hmm. I just can't find anything to trade on this one. I broke it all the way down to a 5-minute chart. The reason why it's hard is because it's kind of going flat here and not really giving me a downward trend. And that's what I'm looking for. I'm looking for something where it's just trending, time frame where it's trending, where I can get in and make money while it's trending. Boom, boom, boom. So this is going to be one that we're going to have to sit out for a minute. This is off the 5 minute chart. And as you can see, fibs take place on every single freaking time frame, man. It doesn't matter what time frame. You can come in and you can find it. You just gotta kind of be careful though, because the more you get, shrink, the more you get smaller and smaller, the more you get susceptible to noise in the market. So you always gotta kind of be careful with that. But still, you see what I'm saying as far as coming in and being able to extract information. Let's see. I mean, if you really want to, you can come in and say, boom, blah, boom. Okay, so it's 54 pips there. 47 is like a 1-to-1 risk to reward ratio. Is it worth risking 47 pips to get 50 pips, 54 pips? Yeah. Is that really what it is? Let's see. Yeah. 54 pips. Yeah. Why not? I'll do it. Just for test mode only. So, let's place an order. So we're gonna sell. Let's sell one lot. We'll come back in and place our stop losses and stuff. So 47. So the take profit is 54. Let me see the place order. Yeah, cool. Alright, so we'll see how this one work out for us. As you see, we put in our sell, we put in our take profit, and what we did is we just used fibs just to kind of determine where our level should be at and what we should be looking at for the take profit doing off a 5 minute chart. Once again, because when we're looking at a daily chart, right, we saw the price was going down, but there was a lot of risk. There was a ton of risk between where we saw price going to, which was at the this number here, the 1.79665, versus the swing right here. This right here is about 440 pips. This right here is about 200 pips, and we didn't, from where the price is currently at now, and we didn't have 200 pips to risk, because that would greatly affect our account. Much further risk, was it 47 pips? Could live with that a lot more. Better if I lost 47 pips versus if I lost 200 pips on one particular trade. And in the process, we're looking to gain maybe about, 54 pips out of the process. So we'll see. So right now we're negative 54, but that's okay. I'm not worried about it. We'll see how it plays out. Anyway, that's all I really have for you guys. For tonight, anyway. If you got any questions or concerns, give me a shout out. Hit me up at Forex Tech Magazine, or questions at forextechmagazines.com, or Lewis at forextechmagazine.com. Love to hear from you. Love to hear your thoughts and see if there's anything I can do or share with you, anything that you may be interested in. Anyway, have a great rest of your day. Hope you make a ton of money trading. Check back in with me in another 24 so that way we can follow up and show you how these trades worked out. Anyway, talk to you soon. Take care.